Credit creation. Hello everyone. Commercial banks play a crucial role in the economy by providing credit to individuals and businesses. Credit extension, the process of lending money to customers, is a core function of these financial institutions. This session will explore the fundamentals of credit extension and its significance in the banking industry. What is credit creation? Credit creation is the process by which commercial banks increase the money supply. It involves banks extending loans, leading to new deposits and further lending opportunities. This process is fundamentally linked to the fractional reserve banking system, where banks are only required to hold a fraction of their deposits in reserve. Banks don't just hold money, they create it. This process is credit creation. It's key to economic growth. Loans fuel credit creation. New money enters circulation. Deposits become the basis for more loans. Credit creation fuels economic activity. Businesses invest. Consumers spend. It drives growth. You can see some definitions of credit creation. The definition on the right-hand side is the definition of credit creation according to the Law on Credit Institutions established in 2024. Credit extension means an agreement that allows an organization or individual to use a sum of money or a commitment to allow the use of a sum of money on the repayment principal by lending, discounting, finance lease, factoring, bank guarantee, letter of credit or another credit extension operation. According to this definition, there are two parties involved in a credit relationship, the lenders and the borrowers. In this course, the lenders are commercial banks and the borrowers could be individuals, operations or corporates. Credit means the transfer of the rights of using the amount of funds from the lenders to the borrowers with specified terms and costs. Credit creation must have three conditions as follows. The first condition is transferring the right to use the amount of funds from lenders to borrowers. This means the repayment must be made by borrowers. The second condition is a credit transaction must have a certain term. It could be 7 days, 1 month, 1 year, or even 10 years. And the last condition is the repayment must include both the principal and the cost of credit, which is called as interest rate. What is the importance of credit creation? Credit creation is extremely important not only for commercial banks but also for the economy. Firstly, credit creation fuels economic expansion. It allows businesses to invest. Consumers can make purchases. Consumer spending rises with credit. This boosts demands. The economy is stimulated. That is how credit promotes economic growth. Secondly, by extending credit, banks increase the overall liquidity in the financial system, allowing consumers and businesses to access the funds they need to make purchases, pay bills, and invest in their future. Thirdly, credit also strengthens relationships between customers and banks. The credit extension process enables banks to deepen their relationships with customers, understand their financial needs, and provide tailored solutions that build trust and loyalty over the long term. And finally, credit provides businesses with the capital they need to expand, invest in new opportunities, and drive economic growth. Effective credit management helps fuel the engine of commerce. Credit also enables business startups. Existing businesses can expand. This drives innovation. For the economy, credit fuels consumption and investment, thereby promoting economic development. Through the credit creation of commercial banks, idle capital is utilized more effectively. However, credit can also lead to an increase in inflation rates. What factors affect credit? Firstly, economic condition can be the first factor affecting credit. Economic growth fuels borrowing. High inflation discourages lending and interest rates greatly influence demand. Government policies also play a role. Fiscal and monetary policies affect credit availability and regulations can tighten or loosen lending. Secondly, internal factors of commercial banks such as capital adequacy or target profit are also factors affecting credit. Capital adequacy is crucial. Banks need sufficient reserves. Risk appetite impacts lending decisions. Profitability targets matter. Banks need to balance risk and return. Management strategies affect credit creation. Thirdly, demand for credit, consumer and business confidence is key. Strong demand drives credit expansion. Investment opportunities influence borrowing. The availability of other financing options also matters. Alternative sources can reduce reliance on banks. Competition influences credit terms. And finally, global factors could also affect credit. International economic conditions matter. Global crises can impact lending. Exchange rates can influence borrowing costs. International capital flows influence credit availability. Foreign investment can increase liquidity. Geopolitical risks can affect lending. These are forms of credit extension. They include factoring, banking guarantees, lending, discounting valuable papers, financial leasing, and letters of credit. In these forms of credit extension, we will focus on lending, the most popular form of credit extension in Vietnam. Lending means a form of credit extension whereby the lender gives or commits to give the borrower a sum of money for use for a specific purpose in a certain period on the principle of the payment of both principal and interest. The following part is credit classification or lending classification. Based on the loan term, credit can be divided into short-term loans, medium-term loans, and long-term loans. Short-term loans are loans having a maximum term of 1 year. Short-term loans are often financed for personal expenses or working capital purposes. Medium-term loans are loans having a term from over 1 year to a maximum of 5 years. These loans are normally mortgage loans, car loans, or financing investment projects. Long-term loans are loans having a term of over 5 years. They often finance long-term investment projects. Based on the lending methods, credit can be divided into the following methods: 1. Short loans, syndicated loans, line of credit loans, current account overdraft facilities, revolving loans, and rollover loans. This course only focuses on 1 short loans and line of credit loans. The one-shot loan is a very popular lending method. In this method, the credit institution and its customer implement lending procedures and conclude a loan agreement each time when a loan is needed. Line of credit loan is also a popular lending product of commercial banks. The credit institution determines and agrees with its customer on the maximum outstanding amount of debt maintained during a specified period. Regarding credit or lending operations, one of the most important issues is interest and interest rate. Interest on the loan is the price of the amount of money that the borrower must pay to the lender to have the right to use the amount of money in a certain period, while interest rate is the percentage charged by a lender to a borrower for the use of money. For commercial bank lending, this rate reflects the cost of borrowing and the risk associated with the loan. There are some types of lending interest such as fixed interest rates, floating interest rates, and a combination of fixed and floating interest rates. Fixed interest rate means the interest rate of a loan is fixed at a certain interest rate during the period of the loan. This type of interest is often applied to short-term loans. A floating interest rate means the interest rate of a loan is not fixed at a certain interest rate but changes periodically throughout the loan. Medium and long-term loans are normally used for this type of interest. A combination of fixed and floating interest rates means the interest rate is only fixed at the first repayment period. The fixed interest rate is normally applied for the first year of lending. In the following years, the lending interest rates are floated. The lending interest rate must be stated on the credit agreement or lending agreement. If customers repay loans on agreed terms, the amount of interest is charged on the principal at the agreed interest rate to the period of loans. If a customer fails to repay or fully repay the agreed amount of loan principal and/or interest at the payment due date, the customer shall be obligated to repay loan interest at the late payment interest. Please read carefully the content of late payment interest in the textbook, slides, and relevant regulations to understand how to examine the late payment interest and how to calculate the amount of repayment in case of late payment.